Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our webinar. We're going to cover some advanced topics related to self-directed retirement accounts and investing, so I hope you will find this interesting. Before we get started, I do need to cover just a bit of information about STC. We are a retirement plan administrator only, so we do not provide legal, tax, or investment advice to our clients. We also don't represent or sell securities or investments of any kind. We're not a registered investment advisor. And I may talk about some investments during this webinar, but we don't represent or endorse any particular investment opportunities that I might share in this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts, some account specifics, and we're going to talk a bit about Roth conversions. Also, we're going to cover in detail non-recourse loans and the tax subjects of UBIT and UDFI. I'm going to share with you the retirement account LLC structure that STC uses for each of our clients' accounts and why we offer that service, and then all the other detailed services we offer as an administrator. And then I will open the floor for your questions. So first, to get started, I do want to give you a definition of what we mean when we use the terminology self-directed retirement account. We don't mean that you have the freedom to choose from a wide variety of list of assets that the company holds. Rather, we allow you to choose any asset that is allowed by law. By the IRS ERISA rules. So you can choose any allowable type of asset, and that would include what some companies consider non-traditional assets like real estate or loans or tax liens. Those are permissible in a retirement account, and so in a truly self-directed account, you could choose that type of an investment. Self-direction also means that you are in control. You're going to manage your retirement plan's investments. You're going to make the decisions about buying and selling, improving a property if you happen to have a piece of real estate, if you want to make a loan, what the loan terms will be. So you're going to be managing and making the decisions related to the investments in your retirement account. So you truly have control. Now, why would you be interested in self-direction? Well, for one big reason is you can truly diversify into a wide range of different types of assets that don't correlate with each other in the marketplace. So, for example, I mentioned you can include real estate, mortgages, notes, make loans. You can actually even invest in private businesses in a self-directed account. I mentioned control already. And another big advantage in a self-directed account, if you're interested in holding realty in your account, is the ability to use leverage. In other words, your retirement account can get a loan for property. We will talk about that more in detail. There are definitely rules that relate to that leverage, but it certainly is permissible and can afford you some more opportunities in real estate investing. Now, there are a number of different types of retirement plans, and I will mention that the IRS did release the 2023 contribution limits recently, so there are going to be some increases next year, which will be a nice thing for those of us who are still saving in our retirement accounts. But some accounts that you are probably familiar with, traditional IRA, Roth IRA, these accounts both have identical maximum annual contribution limits. And for 2022, that amount is $6,000 from your earned income. And if you are 50 years or older, you can bump that up another $1,000 to a maximum of $7,000 from your earned income. That is going to go up next year. A SEP is a simplified employee pension plan. This is often used by small business owners. It does permit an employee and an employer contribution if the plan is set up that way. Sole proprietors often use this type of plan, and it allows you to put monies from the earnings of that business into a retirement plan. So the SEP contribution limit for 2022 is $61,000 from the earnings of the business. A simple plan, a savings incentive match plan. Again, different type of plan with some different kinds of rules. And this one allows you to contribute $14,000 from the business that the plan is on, from your earnings. And if you're 50 or older, an additional $3,000 in 2022, up to $17,000 total. Now, I brought out onto your slide 4 plans that all say former employer. So let me tell you what type of plan that is. 401k, often for-profit corporations will have 401k plans that their employees can participate in. 403bs, often used by nonprofits or charitable organizations for their employees. TSAs are tax-sheltered annuities. TSP, thrift savings plan. So if you formerly worked for an employer and participated in one of these types of plans and you no longer work there, then you can move the money out of that plan into a plan that you are currently eligible for. Now, I will also mention that if you are currently employed and participating in one of these types of plans, then you would need to get in touch with your plan administrator at your corporation or employer and find out if you are eligible to move, roll over, transfer any portions of the monies that you have in the plan to a self-directed account. So you would need to check with your plan administrator in that case. Now, I just brought up a solo 401k plan on the slide. This is one of the newer types of plans. It was created for sole proprietors, for people who are in business by themselves, for themselves and by themselves. They really don't have any employees, very limited employees. Maybe a spouse is working with them in the business. And this gives that sole proprietor a similar opportunity to a 401k. You can make both an employer and an employee contribution, because as a sole proprietor, that's what you are, both employee and employer. It also has some nice features that can be designed into the plan. There is an opportunity to have a Roth provision, and a Roth monies are post-tax. I didn't mention that when I talked about the Roth IRA. That is a distinction of Roth monies. You do pay tax in the year that you make the contribution, but then the monies that are earned in that Roth account are earned tax-free. When you take distributions that are qualified, you don't include those distributions in your taxable income. So we'll talk a little bit more about Roth, but that is a nice feature of a solo 401k if you'd like to add that. You can have a Roth provision. There is also the opportunity to have a loan provision. So sometimes, oftentimes, small businesses, sole proprietors might need monies to expand, for working capital, for whatever reason, or just need money from their plan. With a loan provision, you can borrow funds from the solo 401k plan. So that is a very nice feature. With the solo 401k plan, the maximum contributions for 2022 are $61,000, same as a SEP, and you do have the opportunity for a catch-up provision of $6,500, taking it up to a total from the business earnings to $67,500. So just some nice things to keep in mind. Now, one thing about the solo 401k plan, if you are a sole proprietor and currently don't have a solo 401k, but would like to consider setting one up and making a contribution for the current year, 2022, you do need to have that plan set up by December 31st. So you will want to start immediately working on those plan documents if you're in that particular situation. Now, let's talk a little bit more about some account specifics. You can move monies between different types of accounts, and that would be called portability and often consolidation. So you can move money back and forth between a traditional IRA and a SEP. So let's say you start a business and you decide you would like to set up a SEP on that business. If you had monies in a traditional IRA, you could move those monies into the SEP account if you wish. And the reverse is true also. If you have a SEP, perhaps you're going to close down that business, you can move that money into a traditional IRA if you like. And of course, you can also consolidate accounts. If you have multiple traditional IRAs, you can move the monies into a single traditional IRA. Now, you can also move money from an IRA, a SEP, or a simple plan into a Roth plan. But you'll remember that I did make a distinction on the prior slide that Roth contributions are post-tax. So if you want to move monies that are pre-tax, which are IRA money, SEP money, simple money, into a Roth, then there will be a tax consequence. So they are not like money accounts, whereas the IRA to the SEP, SEP to the IRA are like monies. They are all pre-tax monies. But in this situation, you would be moving pre-tax money into a post-tax type of account, a Roth. So you will have a taxable conversion cost. You will have a cost to do that. You can consolidate like kinds of accounts that would not be subject to tax. Rollovers to Roth from non-Roth accounts, again, would be included in your income and taxed in the year that you do that. Then once you have had that Roth account open for 5 years, 60 months, then you can begin taking tax-free distributions if you have reached retirement age of 59 and a half, as defined by the IRS. So with simple IRA plan distributions, one other thing to keep in mind is that there is a 2-year period after beginning participation that if you take a distribution before that, you might incur additional tax. So just something to check with your tax accountant if you're thinking about rolling over between accounts, especially if you're considering rolling over into a Roth, what that tax consequence might be and how you might mitigate that by certain actions or certain ways you might roll over. Now, a little bit about contribution limits and RMD. RMD stands for Required Minimum Distribution, and some accounts do have required minimum distributions once you reach a certain age. So I've already mentioned that the traditional and the Roth IRAs have like contribution allowances, $6,000 in 2022, 50 years or older, add $1,000, $7,000. I mentioned the SEP was $61,000, but what I didn't mention is that there are 2 different ways you could be paid from a business that you have your SEP on. You could be getting a W-2, in which case your contribution is limited to 25% of your W-2 income up to a maximum of $61,000. Or if you're showing your earnings from the business on a Schedule C, self-employed income schedule on your tax return, then it would be 20% of your self-employed income up to a total of $61,000. So there is a little difference there depending on how you pay yourself and how you show that in your tax returns. Again, check with your tax accountant to help you understand if there's any nuance of that would make a difference for how you pay yourself. Simple plan, I already mentioned, was $14,000 up to $17,000 if you're over 50. Now down to that required minimum distribution. A couple of years ago, the age requirement at which you had to take a required minimum distribution changed. It was the year you turned 70 and a half, and that changed to the age of 72. So now when you are 72 with certain accounts, you are required to take a minimum distribution. The exception to that is a Roth account. There is no RMD in a Roth account. And so that would also apply to a solo 401k Roth money. There would not be a required minimum distribution there. And actually, a solo 401k doesn't have that requirement anyway. But the other plans do. Now, each year, at the end of the year, once you reach that age and have to begin taking distributions, an annual valuation is done of your accounts, all of the accounts that you have. You could have multiple accounts. And that valuation of your accounts as of 12/31, that valuation combined, there's an equation that is applied to that determines the dollar value of your required minimum distribution. And then the rules about getting that money, receiving that money, or that value from your account. So again, another question for your tax accountant when you reach that age and will be required to take distributions, which will be part of your taxable income. Okay, so just a few things to also keep in mind. If you take an early distribution, if you haven't reached age 59 and a half, and you take money out of your account, those monies are usually subject to an additional 10% tax as a penalty tax. And those distributions must be reported to the IRS. They will be reported by your the company that you took the distribution through, the company holding your account. And if it is a Roth distribution, then the portion that is attributable to contributions would not be taxed, but the earnings would be. So you do want to be cognizant of the fact that there are some penalties if you take early distributions. Now, there are some exceptions. There are some reasons that the law does permit you to take distributions without incurring the penalty. You will still have to pay taxes on distribution. So there are some things, disaster relief, there are some medical expenses that could potentially allow you to take a qualified distribution. Birth and adoption was one of them. So you will need to check into that with your accountant if you are interested in taking an early distribution for a specific purpose, to see if that purpose does permit you to avoid the penalties. I want to go into a little bit more information about Roth accounts. People are definitely looking for ways to earn without paying taxes on the earning, and that is an advantage that the Roth has. Of course, as I mentioned, you pay tax on the contribution. The year that you make that contribution, it is included in your taxable income. But then as the money is in that Roth account and as that money grows, I actually have an investment in my Roth account that is earning me 7%. So those earnings of 7%, and I'm actually having them reinvested into the capital, so I'm earning on my earnings. When I take qualified distributions, those monies and those earnings are tax-free. I will not have had to pay taxes on those 7% interest that I've been earning. So that's a huge advantage. If you have investments that you would like to earn on a tax-free, you may want to consider a Roth account. Now, I've already mentioned qualified distributions, having to be 59 and a half, mentioned that there is no RMD, but there is that 5-year holding requirement. So if you don't currently have a Roth, you want to get it, and you want to have one, you want to get it set up as soon as possible because a clock starts and you can't take qualified distributions for 5 years. So there is that 5-year holding period. There are also income limitations. Now, that changes year to year, and I'm not going to go through all those numbers because it depends on your modified adjusted gross income and how you file your tax return, what status. So you will want to check with your accountant. But there are income limitations as to who can make contributions. However, you can make a contribution into a traditional IRA and then convert it to a Roth. So that is a possibility if you don't fit into the requirements to make a Roth contribution straight away into an account. Now, conversions are going to have taxes due and payable in the year of the conversion. So just a couple of things to keep in mind. And the taxes are paid from the converted account. If you have monies that you want to convert into a Roth account, but the tax consequence is too significant to do the whole amount at once, you don't have to. You can convert, let's just say 20% this year, 20% next year, 20% the following year, and over a 5-year period, convert your Roth monies or your non-Roth monies into Roth monies. And so then your tax consequence would be split up over those 5 years. So that is permissible. You don't have to convert the whole amount in the account. One thing to keep in mind if you do that is each of those conversions has its own 5-year time period. So if you converted 20% this year, that clock starts ticking when that conversion happens. So 5 years from now, you can take monies from that portion tax-free. And then if you wait till next year to do another 20%, then the 5-year clock starts ticking on that 20%. So just some nuances to make sure you talk with your tax accountant about, make sure that you understand that. When you do the conversion that year, the taxes are due and payable that year for the monies that you converted. And if you pay those taxes from the converted account, that is a distribution. And if you are not 59 and a half yet, then that is an early distribution, which could also have a penalty attached to it. So again, something to think about. It's often worthwhile to convert to a Roth account, but you do want to make sure you understand all of the things that come into play when you do that. So that might be considered an early distribution and have a penalty on it for taking the taxes that are due from the account. You can convert multiple accounts at the same time and put them all into one Roth account. So I know several people who have different traditional IRAs that they started with different companies and they'd like to get that money all in one pot. They could put it all into one traditional IRA, but they could also convert it all into a single Roth account as well. Again, you can convert partial amounts, so you don't have to do the whole account, thinking about that there's going to be a tax consequence. And then, as I've mentioned, check with your accountant because that they'll be able to help you understand and determine what's the best course of action for you. Now I want to move on to another topic that is often of great interest because I often have a lot of real estate investors who are interested in owning real estate in their retirement accounts, seeing it as an investment that doesn't directly correlate to the stock and bond market, an investment in realty. So it may be, and maybe oftentimes is the case, that you cannot fully fund a real estate purchase with the monies that you have in your retirement account. You have insufficient funds. So you can use a non-recourse loan in your retirement account to fund purchase. So let's talk a little bit about first what is a non-recourse loan. Now, you are not getting this loan. Your retirement account is getting the loan. Your retirement account doesn't have a job. It is an entity. So the non-recourse is more like a business loan. It means that the security instruments, the notes, the mortgages, they don't allow any recourse for repayment if there's a default on the loan to you, the account owner, or other monies or investments in your retirement account. The lender only has recourse to the actual property that the loan is on. So in the event of a default or foreclosure, the property is the only source of repayment for the loan. So it is more like a commercial loan, a business loan. Obviously, your retirement account doesn't have a job, so there's no income or employment verification. And I'm going to go through just some general industry standards, but if you are looking into a non-recourse loan, you can go out and find non-recourse lenders and talk to them about their particular terms for the type of property that you are interested in investing in. In general, the required documentation that most lenders are going to have is, of course, their loan application, a purchase and sale contract, and then they're going to want to see an IRA statement or whatever type of retirement account you have, SEP, whatever it is. And they're going to want to see the funds that are in it. They're going to want to see that statement. They'll want an appraisal of the property, and if it's a rental, they're going to want to see a rent roll. Now, as far as loan guidelines go, the maximum loan to value will likely be 70%. In other words, you're going to need to be able to put down 30% of the purchase price from the monies in your retirement account. Maximum term, 20 to 30 years, that's definitely doable. We do know folks who have gotten ARMs, adjustable rate mortgages, 3-1, 5-1, 7-1, so you might be looking at that as well. The lender will also likely be looking for an income to expense ratio of 1.25. They're going to want to see that. Again, there's no recourse to them except the property on a default. So they're going to be looking at these things. And they will likely require you to hold money in reserve in your account. Generally 3 to 6 months of expenses, of property expenses. So let's talk about that for a little bit. Why? Well, if you're owning a piece of real estate, there are expenses that are attached to that real estate that must be paid by your retirement account. For example, property taxes. There could be repairs that come up, could be unexpected repairs. There's a storm, you have wind damage, you need to fix the roof. The water heater goes out. Anything related to the maintenance of that property that's owned by your retirement account is required to be paid from your retirement account. So the lender is going to want to see that you've got cash that can cover those kinds of things, bills that will come in normally and then unexpected things. So each company may have different requirements, and it may be dependent on the type of real estate that you have, but you will likely have to have some kind of monies held in reserve. Now, if you have a job, if you're earning money, if you have a business and you're earning money, you are eligible to make a contribution into your account, but the amount of that contribution may or may not be definite, and the expenses that your property could incur are also indefinite. So they will want to see some cash held in your account for reserves. Now, eligible and ineligible properties, things that we've seen lenders will do non-recourse loans on, single-family residence. So we often have real estate investors who want to purchase rental properties, purchase a house and maybe in a college town, have it rented to students or whatever. And so then that would certainly be eligible for a non-recourse loan. Some condos are eligible. 2 to 4 plexes, so buildings that have 2 to 4 units in them, and also multifamily units, so like an apartment building, 5 or more units. Also retail, office, warehouse, those are eligible for non-recourse loans generally. Now, things that are not eligible, mobile homes, timeshares, condo hotels, that has become pretty popular in recent years. Certain restaurants, again, you'll need to check with your particular lender. Residences with 5 or more acres and farms, those are generally ineligible for non-recourse loans. So that gives you a little bit of an idea. So, but if you're looking at, a single family home or a duplex, something like that, that normally would be. So you will want to look at the dollar value that you have in your account. Could you fund 30% or more and still have reserve monies and purchase a property? Now, along with that non-recourse loan comes another topic that I want to talk about. The first topic is unrelated business taxable income, or UBTI or UBIT, unrelated business income tax. So most of your IRA investments generate passive income. Now, UBIT was designed by the IRS so that charitable organizations that don't pay taxes wouldn't have a benefit over for-profit organizations who do pay taxes if they had an income-producing part of their business that wasn't tied to their tax-exempt status. So let me give you a little example. Let's say you have a public university. It is a nonprofit, but they rent out their, let's say they have a concert hall. They rent it out for concerts, and they make income that way. Those concerts are not a part of their tax-exempt status of education. So the IRS determines that that kind of income would be taxable, even though they are public. They're not taxed normally. So now the IRS has ruled that this unrelated business taxable income can also apply to certain types of income that are generated in a retirement account. So most of your IRA investments are going to generate passive income. You're not going to need to worry about this. That's the largest cases you're not going to pay taxes. Interest income, rental income, dividends, distributions, that's all passive income. Now, again, since I often have real estate investors listening, if you are investing in real estate, the sale of real estate would also generally be considered passive, as long as the intention of that purchase was to hold it, for appreciation, to generate income, long-term gain, down the road, sell it. Now, rare exceptions can exist where the IRS might consider an investor an active participant. In other words, if you are doing so many real estate transactions through your retirement account, buying, fixing up, selling, buying, fixing up, selling, and you do that a number of times during the year, then the IRS might view that as a business within your retirement account, and the income becomes taxable. So you will want to talk with our client services department and your tax accountant if you are interested in doing many transactions like that that might be considered a business. So we will give you some guidance, and you, with your tax advisor, can determine what you would choose to do. But it's just something to keep in mind. There are rare cases where you could generate tax by investing in your retirement account. Now, there is a subset of UBIT called unrelated debt financed income, UDFI. And this applies to income that is generated from an asset that was purchased using financing. So now we're back to that example of your retirement account getting a loan to purchase a piece of property, and that property generating some kind of income for you. UDFI would apply to the income earned on that debt financed property. So let's talk a little bit about this. It is based, the UDFI tax is based on the net income of the property. So any expenses related to that property are deducted from the income. So and then what's left is what's subject to tax. The first $1,000 of that net income is exempt. So automatically you get $1,000 tax exempt. And then the portion of the remainder that is taxable is based on the ratio of debt on the property. So let's say, for instance, you had 30% of the property you paid and it is debt financed 70%. Then of the remainder after that $1,000 exemption, 70% of the remaining net income would be taxable. So just something to think about. And I'm going to walk you through an example as well. In addition to the income that's earned from the asset, once that asset is sold, then a percentage of any gain may also be subject to UDFI. Now, that changes as you pay off the loan, as your retirement account makes payments on the loan, then the portion that is debt financed changes. So say originally it was debt financed 70%, but now you've made payments for years, a few years, and now it's only 68% debt finance because you have some equity in the property in your retirement account. So when the asset is sold, a portion of that gain will be subject to the UDFI tax unless the loan was fully paid off 12 months prior to the sale. So just some things to think about. You don't need to know all the details because we could help you determine that, and your tax accountant can help you determine that as well. So let's just run through an example to see if using leverage to purchase an income-producing piece of real estate might be of value to you. Let's say you can't really purchase the property without debt financing. So here's our example. We're going to say that you purchased, your retirement account purchased a rental property, 50% debt finance. So let's say it was $500,000. You got a loan for $250,000 and your retirement account put in $250,000. 50% debt finance. Now let's say that the annual rental income from that property is $12,000. And this is net, so that means I've already deducted all of the expenses. You have a property manager, all those expenses have come out, any maintenance has come out, and you are left with $12,000 of net income. Now, the amount of that net income that is going to be subject to UDFI is $5,000. How did I calculate that? Well, I said only 50% of the property is debt financed. Remember, you paid $250,000 for it. So that means that $12,000, 50% of it is not debt financed. So that $6,000 is, $6,000 isn't. So I take $6,000, and then I said that the first $1,000 is tax exempt. So $12,000, 50%, $6,000 minus $1,000 gives you the amount that is actually subject to the UDFI tax, $5,000. Now, the IRS has determined that these earnings, UDFI, is payable at the trust tax rate. And in 2022, the trust tax rate is a graduated rate. It ranged from 10% to 37%. So I did the calculation of that $5,000 in the graduated process. And in 2022, the taxes for this particular example would be $815. So that means your net income on this investment after UDFI is $11,185. So this is how you might want to consider if it's worthwhile to use leverage for an investment. Consider how much you're going to be able to put down, how much is going to be debt financed, the income that you expect to generate, or if you're holding it for appreciation, what you expect to make on that appreciation, and then determine after doing the calculation, well, this amount of net income does make it worthwhile for me, even if I do have to pay some taxes on this investment. So something to consider. if you are looking at debt financing a property. Now, both UBIT and UDFI are reported to the IRS on Form 990-T, and as I mentioned, they are taxable at the trust tax rate, and the taxes must be paid from the retirement account funds. So let me say that again, the taxes must be paid from the retirement account funds. So of course, you just earned $12,000 in that account, and you're paying $815. So you had the $12,000 in the account to pay the $815. So the money is there. You don't pay it personally. It comes out of your retirement account. And so again, do talk with your tax advisor about this and how you would go about doing this process. Now I want to talk, change gears a little bit and talk about the structure that FTC uses for each of our clients' accounts. We do use an LLC structure for our clients' accounts. It's not a generic business LLC. It is a very specialized type of LLC. Its operating agreement, its articles of incorporation are written so that they comply with the rules that relate to retirement account investing. So it's a very specialized type of LLC that is designed to be owned by a retirement account, basically. Now, the reason we use this, there are a number of benefits to our clients. One great one is that it gives our clients a great deal of flexibility in structuring complex transactions. So, for example, let's say you do want to get a loan for a property purchase. Lenders are much more used to lending to LLCs, businesses, persons, rather than retirement account number 12345 for the benefit of Susan Jones. So it gives you that kind of flexibility. It also gives you some anonymity. It helps you in structuring transactions that maybe have multiple parties to the transaction. So different kinds of ways it can give you a lot of flexibility. It does provide an additional layer of asset protection. It is a limited liability company, even though, albeit a specialized one. It also gives you checkbook control over your retirement funds so that you can immediately respond to an investment opportunity. Now, you'll notice I have checkbook control in quotes, and that is because, unlike some companies, we do not give the checkbook to our client. We actually are the administrative manager of this LLC. So we review your transactions. You're the investment manager. We review your transactions to make sure that they are not going to be prohibited transactions, and to help you make sure that your documents are titled properly, etc. So we look over your transaction, and then once we see that it's a viable transaction, we can same day or next business day fund that transaction. So what you really have is protected checkbook control. You have our experts looking over the details of your transaction, and then once you know it's a go, then sending the funds to the seller, and the seller transfers the ownership to your retirement account held at FTC. So it's kind of the best of both worlds. You have experts, but you've got that immediate response to an investment opportunity. Using the LLC structure does simplify asset titling. So back again to a real estate transaction, you don't have to send those closing documents to our corporate headquarters where somebody sits and reviews them. Rather, you can actually go to closing on behalf of your retirement account. Now, you would send client services department the documents the day prior or in advance of that so they can look them over, make sure that everything looks good, but then you can actually go to the closing and sign the paperwork for the purchase of the property. So it does simplify the asset titling. It also, using the structure, also makes it simple and straightforward to partner or pool funds with other funding sources. So what I mean by that is your retirement account does not have to be the sole owner of an investment. It can be one of several owners. It can be a co-owner. So let's talk a little bit more about that. You can partner with others and invest in properties, investments. Now, if you know anything about prohibited transactions and disqualified persons in retirement account investment transactions, you will know that your retirement account is not able to do a direct transaction with you personally, with your spouse, and with certain family members. They are disqualified persons, and that would result in a prohibited transaction. However, using the LLC structure, and if the purchase transaction is structured properly, you can partner with your own personal investing money, or your spouse's money, or your spouse's retirement account, or your father or your daughter. So you can partner with those entities and co-own an investment. Other investing colleagues, you can partner with LLCs. They don't have to be individuals. You can also be a part of an investment syndication. So you have quite a bit of flexibility with whom you can partner for an investment. Let me show you a little schematic here of our retirement plan LLC structure and how you could use that to invest and co-invest. So if you look on the upper left, you'll see this is your current custodian where you currently are holding funds in your plan. You would complete some paperwork that would direct your current custodian to transfer or roll over the funds to our self-directed custodian. While that is happening, our operating department is setting up the LLC that's going to be owned by your retirement account in the state of your choice. You're going to give it a name. You can discuss with them what state you want to incorporate your LLC in. They can give you some guidance based on what you think the transactions are going to be. And then once the money move from our custodian into the bank account that your LLC has access to, then you're ready to invest. So in this example, your retirement account owns investment number 1, which is a tax lien. So you are earning interest on that tax lien, and then the principal when it's repaid. And if for some reason it's not repaid, then your retirement account can actually foreclose on that tax lien, and then you would own a piece of real estate in your retirement account. Your second investment is gold bullion. We are seeing folks invest in that these days, and silver and other precious metals. We do hold those investments for our clients. So if you're interested in that, we can also help you in that area. And then you see investment number 3, foreclosed real estate. Your retirement account found a property that was in foreclosure and purchased it, but you aren't the sole owner of it. Your retirement account owns some of it, so does your father, so does your daughter, and then you also put some of your personal money outside of your retirement account into this piece of real estate. Normally, those 3 parties are disqualified persons, but if you see in my yellow block here, if you co-invest at the inception, at the beginning of the purchase transaction, then this is a viable, allowable transaction. And our client services department can help you structure that properly so that that is a good investment that will work. So that's a little bit about our LLC structure and why we offer that. I do want to go through the services that we offer. We are a full service self-directed retirement plan administrator. This is all we do. So we offer you that LLC structure setup I just mentioned, that protected checkbook control. We have CPAs and attorneys available to answer your technical questions. Our client services department can offer unlimited amount of guidance on transaction compliance with the rules and the regulations. We will handle all of that back office paperwork support. A lot of records have to be maintained for retirement accounts. We will maintain LLC financial statements so that you will be able to run your retirement account like a business, like a corporation. We'll supervise the regulatory reporting, and we'll oversee the annual valuation. So basically, you will be able to focus your attention and time on finding the best investments for your retirement account, and we will take care of all the back office administrative stuff for you. So how can we serve you? Perhaps you know you want to open a self-directed account. We can get you some paperwork and get you started on setting up and opening an account. You may also have clients of your own or colleagues who might be interested in self-direction, or you might just need more information. If any of those is true, please get in touch with us. We have a lot of information on our website, stcira.com. Our corporate number is there for you, and my direct email address is there. So you can always contact me with questions that you have after this webinar is completed. So let me just take a few moments and check for questions. I think I have a couple of questions that came in while I was giving the webinar. I have just a few more minutes to go over those. Okay, so this is somebody who's asking a question about the required minimum distribution. Is the required minimum distribution based on total assets, cash in hand, or equity? Okay, so let me kind of give you a bit of a thorough definition here. Generally, it's the RMD is calculated for each of your accounts by dividing the prior December 31st balance of that IRA retirement plan by a life expectancy factor, and the IRS publishes that. Now, if you own real estate, then the fair market value of that property will be included in the balance of the account for purposes of calculating the RMD. But if there's debt on that, that will be deducted, so it will be equity. If you have more than one account, which many people do, the RMD is calculated on the combined balances of those accounts, but the distribution, the RMD, can be taken from a single account if you wish. So those are just some things to keep in mind as year end comes. If you have reached the age of 72, and you are required to take a minimum distribution. Okay. If you have a rental property in your account, who does the renter send their rent check to? Okay, that really depends on whether or not you are using a property manager. We do highly recommend that you do use a property manager. They will take care of your property for you and make sure that you maintain an arm's length distance from that property, because again, you don't own it, your retirement account does. So typically, if you're using a property manager, that they will collect the rent, the checks are made payable to them, and then they will take their fee from it and forward payable to your retirement account, the excess funds. So then they would send us that check made out to your IRA LLC account, and we would deposit it in the bank in your IRA LLC account. Now, if you're not using a property manager, then the checks need to be made payable to your IRA LLC. They can't be made payable to you. They have to be made payable to your IRA LLC and mailed to our office or to you, but if they're mailed to you, you'll have to mail them to our office. So that would just save some time. Now, I mentioned that you could co-own a property with your retirement account. In that case, the monies would need to come to each of the entities separately in the portion that they own that property. So let's say you owned that property with your retirement account 50-50, and the rent was $1,000 a month. The rentor would need to send you a check for 50% and your retirement account a check for 50%. So just some nuances of co-owning a property. Doesn't have to be difficult. Those can all be worked out. And they do give you a lot more flexibility when you can do that type of thing. Okay, one more question. If I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with the IRA fund? Yes, yes, you can. We actually have clients who might do that because they want to do trading. And also, let's say they sold an investment, they have cash, they're looking for the next investment, and in the meantime, they want to trade with those monies and earn on them. So yes, you can. You do need to open the brokerage account as a business account. It can be with any company that you choose, but it does need to be a business account in the name of your IRA LLC. And then we do request that you send us copies of your monthly statements because we need to be sure that you're not adding money directly into that account or taking money directly out of that account. Again, it is your IRA's account, so the money has to flow into your IRA and then into the brokerage account, from the brokerage account into your IRA, and then back to you as a distribution if you're going to take the money out. So, but you certainly can do it, and we can assist you with that. Thank you so much for joining me this evening. Please do get in touch if we can be of assistance, helping you get an account set up, or you have further questions. Our website has a great deal of information on it, and I do these webinars once a month, so I hope you will think about joining me for December's webinar. Thank you so much. Hope to see you again soon. Bye.